Good morning, everybody. Thank you for joining us today for our Q3 19 Event-Driven Distress Webinar and Teleconference. Some housekeeping and disclaimers for a moment before we begin. This call is for investors only. If there are any media or press on the line, please disconnect and be in touch with us directly later today. Our review and presentation may contain non-public information and is subject to confidentiality agreements. Please see our disclaimer in the back of our presentation materials for further details. Our webinar and teleconference call is a generalization summary of our views, and for a more detailed review and examination of our thoughts, please see our detailed quarterly letter that we have updated this morning to Syntrack, our virtual data room. If you have any technical problems during the webinar, please email investorrelations@samco.net. Additionally, at the conclusion of the webinar, we'll have an opportunity for Q&A after the formal presentation. There'll be instructions on the screen as to how to raise your hand and then ask your question. Again, thank you very much for joining us. And now to our overall presentation. Year to date through September, we've unfortunately underperformed. We're down 7.5%. due to losses from our long post-distress stocks. Our worst performers were issued in firms of metal and mining, mostly coal, with the changing macro landscape that caused demand expectations to drop within that industry. We did curtail some of the losses by hedging the industry, but our losses unfortunately more than offset the gains from our hedges. We're much more optimistic at the moment about the future given the current macro conditions. Over the long term, however, our 3-year returns of plus 6.1% remain ahead of our benchmarks, which we will see and discuss a little more internally and ahead in the presentation. We also note that during this time period, investor appetite for value stocks and active management have waned dramatically as passive investment strategies have significantly outperformed. Additionally, more and more investors are adopting low-cost structures, whether it's through ETFs or CLOs. Securities that are eligible for structured ownership in these entities have done better given the massive capital inflows. Securities that, quote, don't fit the mold have really experienced sharp and rapid sudden sell-offs, and we'll discuss that further when we go through some of our ideas. This market inefficiency should create more opportunities for nimble investment managers like us, and we look forward to those opportunities and that opportunity set going forward to the end of the year and into 20. We did successfully realize most of our legacy special situation investments. That is in the side pockets. Our fund also, as you know, recently sponsored at year-end 2018 in December, $130 million IPO for our SPAC, and that we bought public the firm using the same strategies that we've successfully and historically employed in the fund. SPACs have become very much mainstream and recently represented a large percentage of all IPOs. Separately, as you've seen in the last statements, we recently consolidated some of our remaining special situation interests and investment pools in the fund, and that basically enhanced our efficiency and really has made our accounting much smoother. Overall, in the macro scene on the monetary and fiscal policy remains very accommodative, despite the length of the overall economic cycle and business cycle. We continue to reiterate that we would continue to focus on value-oriented stocks from an allocation standpoint with hedged market exposure in single-name shorts and industry hedges. And we're going to talk a lot more about those shorts and those hedges later on in the presentation, as it's a growing part of our book. Event-driven catalysts continue to be attractive and make formally distressed value stocks particularly attractive. From an overall valuation standpoint, the fund's portfolio continues to be attractively priced with a TEV to EBITDA of 4.7 versus 14.6 for the overall Russell 2000, and our shorts are at a high valuation of 14.2 times. Looking to the specific review of the third quarter, like I said, we did underperform our main benchmark, the HFRI. We have outperformed on the last 3-year basis as well as on a yearly average basis, as you can see in the table herein, where the yearly average is 7.3%. We continue to highlight on the year-to-date drivers. Losses from our long holdings again came from our post-distress stocks, and the hedges did help us, but not enough to offset that. We continue to be optimistic, like I said, going into year-end here and into 20 with our positioning in the portfolio, as well as our names and ideas. From an overall macro standpoint, I think many of you are familiar with what is out there right now. We highlight again the GDP strength, unemployment at a 50-year low, CPI, which continues to be favorable on interest rates, the Fed funds target, etc. Obviously, the S&P has had a ripping year of up 20%, but as we point out, many sectors and some sectors are in a bear market. Nonetheless, we recognize the risks out there, whether it's the trade wars, Brexit, length of the cycle, the political situation here in the States on an impeachment basis, and continue to be vigilant on that sense. Importantly, we also take note of the overall negative interest rates around the world, with $17 trillion in Q3. That's really been in negative interest rate area, and really is an example of a real asset bubble at this point. So again, we recommend continued selected ownership of value-oriented names with built-in catalysts, which is very representative of our portfolio. And we are cognizant and cautious and are tempering our long market exposure with hedges and single name shorts. At this point, I'd like to turn it back over to George to review distress trends, and then we'll get into specific names and ideas within the portfolio. Take it away, George.
Thank you, Bill. And thank you, ladies and gentlemen, for dialing in today. It's a beautiful day here in New York. Turning to page 5 of the webinar slides, distressed debt supply has jumped quite nicely, up by $19 billion in the quarter. As most investors probably would expect, energy is leading all sectors in distress, with a default rate of about 11%. The speculative grade or junk-graded default rate in high-yield bonds is about 2.9%, but Moody's expects it to rise to about 3.4% by the end of the year. So far this year, 29 companies have defaulted. A number of, I guess about 7 companies have completed distressed debt exchanges. Combined, that's over $40 billion in distressed deals so far this year. Energy, as I said, and then also the metals and mining space account for about 48% of the total. So that those two industries are, constantly distressed these days. So as Bill alluded to earlier, downgrades or sudden or defaults, and for the CLO market have caused some very interesting sell-offs. One example of that is the Deluxe Entertainment term loan, which we'll talk about a little bit further along in the presentation. It's a just under $800 million term loan that sold off from about 100 cents on the dollar to under 10 cents on the dollar just a few months later. Year to date, the largest junk-rated defaults were Weatherford, which is a coal company, Windstream, which is a telecommunication company, almost $5 billion in debt there. We'll talk about that a little bit further along. EP Energy and Hexion. Now, it's important though, and as for people that follow the default rate, and there's a visual of it on the right-hand side of this slide, it looks pretty low, but it's important to remember that that does not include fallen angels, and sometimes they can be massive, like PG&E with almost $50 billion in debt, including wildfire claims. So not including investment-grade companies that become fallen angels in the distressed debt supply is really deceptive, I think, and I think perhaps self-serving by the underwriters and rating agencies who track junk-rated debt defaults only. Remember, Lehman Brothers, when it defaulted, was a $600 billion bankruptcy, not 600 million, 600 billion before it filed, and obviously that was so big that it caused systemic problems all around the world. So in summary, on the distress trends, there's a lot going on right now. It is concentrated in energy and metals and mining, but if you think about just the default rate, I think you're missing some of the big picture with all that's happening in the space. Let's go to some of the distress trends and themes that we're seeing lately. This is our updated list. We update this once a quarter. I'll just talk about a couple key industries here. In the auto manufacturing space, GM and Fiat are post-distress entities, of course. Tesla, on and off, has been at risk of future distress. Right now, it doesn't appear to be at risk. Renault and Peugeot have been in discussions with Fiat over potential M&A activity, and we'll talk about Fiat in a few slides. Turning to casinos, we saw a big merger in the quarter with Caesars and Eldorado Resorts. We'll give a little update on that in a minute. Caesars, of course, is a post-distress equity. In the coal space, which falls within the metals and mining sector, there's really a lot of activity. A number of post-distress names there, like Warrior Met Coal, Peabody Energy, Contura, and Arch, and a number of other new entrants into distress in that sector, mostly with steam coal as their primary product. In the energy space, there's a lot of new distressed debt. EP Energy and Hexion, we just mentioned, also companies that service that space, be it through platforms, offshore, onshore, servicers, refiners. One new bankruptcy during the quarter, PES, which is a major refinery in Philadelphia, is of note. Turning to financial services, there are a number of companies that are post-distress, like Bank of America and MBIA, that are still pretty interesting. On the government side, Puerto Rico remains the largest municipal bankruptcy ever, next behind or larger than even Detroit, and that's still working its way through. In the industrial space, it looks like McDermott International will probably file for bankruptcy sometime in the near term. That stock has dropped down to under $1 per share recently. That's a big engineering and construction firm that recently overpaid for a major acquisition and funded it with debt. I think the litigation sector is very interesting. With our legal background here at Schulte Asset Management, investments like the Motors Liquidation Trust come to mind, where there's just trust and there's cash in a trust, and resolving remaining litigation disputes is the main driver of the future potential outcome. I think with that kind of investment, you have limited downside risk and also very interesting event-driven upside. Some other more high or widely followed and known companies like Bayer, after it made its Monsanto acquisition, and has, of course, exposure from Roundup lawsuits, which is a weed killer that allegedly causes health concerns. Yesterday there was news with Remington. They just lost a big ruling in the Supreme Court. And we'll talk in a little bit later about just probably briefly, about the Windstream Unity dispute, which is a litigation that's pending as well. Not too much else to say on this page other than utilities, the last bullet. There's a lot going on there, of course, with PG&E in bankruptcy, is one of the top 10 bankruptcies ever. Southern California Edison is actually increasingly at risk as well for really the same thing. And then there are some companies like Vistra Energy, which have recently emerged from distress in that space, that are very interestingly cheap post-reorg equities. And we'll talk about Vistra in a few pages as well. I won't spend too much time on page 7. This is our updated, it shows our updated portfolio exposures. A couple key takeaways. We've reduced the long post-distress equity book. It was about 68% as of the end of the quarter. We reduced it even further after quarter's end. Essentially, we're realizing losses in that book, and you can see that in the next section, with 24% of the gains that are realized during the quarter. A very low win-loss factor ratio in the post-distress equities, and that's one of the reasons we're taking some losses there and moving on. On the other hand, in the short book, we've let all of our gains run during the quarter, and we're being a little bit more accommodative in terms of letting shorts run. The win-loss ratio in the short book was 88% for the quarter, which is a nice high ratio. There's a quick review on our investment strategy here in the middle of the page. I think most investors on call understand that we short sell companies headed into distress, usually focused on their equities, although we recently put on a new short in the unsecured debt of WeWork. So sometimes if a company doesn't have publicly traded stock and the short opportunity is compelling enough, sometimes we'll short their debt as well. Later, when companies become distressed, we typically buy their distressed debt at pennies on the dollar with an equity view to ownership of equity as that debt gets converted into equity through the reorganization process. And then, of course, and again, investors on the call will know this, but of course, after restructuring, and this is sometimes the most profitable part of distressed securities investing, we like to own post-distress stocks in companies that have completely delevered their balance sheet and have good fundamental upside. Sometimes those stocks also have very interesting event-driven characteristics, especially when they do things like pay special dividends, engage in large stock buybacks, or become involved in M&A activity, which all three of which tend to reduce their valuation discounts. A couple comments about position attribution. The best performers, going from the bottom up, the best performers in our fund were Vistra, Frontier, Hornbeck, PG&E, and our metals and mining short. And the worst performers were mostly in the coal space, Contura, Peabody, and Warrior, but we also underperformed with our Fiat position and Deluxe Entertainment. We'll go into each of these in a few moments. I did mention, just going up the bullets here, Caesars. That position, which is our largest long, was somewhat flat during the quarter, but then it appreciated after the quarter on news about their progress with their merger with Eldorado Resorts. One thing I like about Caesars is that it's a very similar investment to our successful investment in Tropicana Entertainment years ago. A lot of the same people are involved. Carl Icahn is the biggest shareholder of Caesars, as he was with Tropicana. With Tropicana, I, of course, helped negotiate their plan of reorganization, which eliminated $3 billion in debt. Caesars was a much larger bankruptcy, the largest casino bankruptcy ever. But Eldorado Resorts, who's the suitor and buyer of Caesars, was also the buyer of Tropicana. We're excited about that merger, and we think that pro forma, when the deal closes, the combined company will be positioned very well. Also, at Caesars, Tony Rodio is currently running it. He's the new CEO that was just appointed. He was the same CEO at Tropicana as well. Why don't we turn to the next page, and we'll dig into some of the winners and losers with specifics. The first one is Contura Energy. This stock generated a quarterly loss for our fund of about 3%. We've been reducing it, taking losses and moving forward. The company is the largest U.S. producer of metallurgical coal. It's listed on the New York Stock Exchange. It came out of bankruptcy in 2016 after eliminating nearly $8 billion in debt. So today it has only slightly above $100 million in debt remaining. The company does have a nice large tax asset, a $1.5 billion NOL, which should shield future tax payments that it may have. Late last year, they completed their merger with their former namesake, Alpha Natural Resources. And as a result of that, Contura became the largest domestic met coal producer in the United States. They have a great track record of returning capital to shareholders, and currently they plan to apply about 50% of their growing free cash flow to future capital returns. Now, these coal companies traded extremely low multiples of EBITDA. In this case, this company trades at 0.95 times this year's EBITDA. As Bill said earlier, the coal stocks all dropped during the quarter. through basically due to several macroeconomic issues, including a belief that long-term demand is softening significantly everywhere except for in China. But this company also had a couple negative events. A couple years ago, they sold some mines that they owned in the Powder River Basin to reduce their exposure to thermal coal. And unfortunately, during the quarter, the buyer of those mines defaulted, and there was a risk that environmental liability from those mines and from the permits that Contura had transferred to the new owner would come back to impair Contura. Fortunately, after the quarter ended, management worked with the new owner of these mines to secure replacement surety bonds, and so Contura is now shielded from future issues related to those Powder River Basin mines that it previously sold. But that was an unexpected development during the quarter, and one of the reasons the stock was pretty soft. As Bill mentioned at the beginning, we did offset some of the losses in the coal space, as well as with Contura stock specifically, with a hedge, and we're happy about that. Unfortunately, it wasn't large enough to offset the entire losses. Right now, Contura stock is trading at about $18 a share, and with their cash flow, assuming a little luck with the macroeconomic environment, which we have, again, hedged somewhat, but assuming they have some luck, this stock has probably a 300% plus upside from where it's currently trading. So even though it's a small remaining position in the fund, we are looking forward to potential positive results from it going forward. Turn to Deluxe Entertainment, please. This is a new position in our fund. I talked about the term loan earlier. This company is the largest end-to-end entertainment and media solutions company in the nation. What it does is it basically offers Hollywood studios, cable companies, TV networks, and home entertainment companies digital solutions in the form of visual effects, picture editing, sound services, mastering, production, distribution. So it's used for major film making. There's a little image here of the Aquaman movie. They also did the Spider-Man movie. They've done lots of different movies. The company has about slightly over $850 million in revenues. Their customers are all the majors: Disney, Warner Brothers, Netflix, Amazon, and many others. During the 12 months ended June, the company, as I said, generated about $850 million in revenue, and management is expecting or projecting just under $120 million of EBITDA for next year. This business was formerly owned by Ron Perlman before it consummated and completed its recent restructuring. In that restructuring, its lenders, including our fund, wound up becoming the equity owners of the business. The company canceled slightly over $840 million in debt, and as a result, interest expense is now dropping from it was over $80 million a year down to about $24 million pro forma. This will give it a lot more financial flexibility to execute on management's plan, which is actually a dramatic cost savings plan. The company is moving its entire staff from LA to India to save on money and to overcome the secular change that this industry has witnessed. So we're excited about the future for this one. The company management expects to save about $64 million in this year alone due to their footprint and rationalization measures, and overall achieve about $135 million in total cost savings. The new stock, which is private but is indicated at about $4 a share, we think it's probably worth closer to $25 a share, which would be more than a 500% appreciation potential from current levels based on where comparable companies trade. Turn to Fiat in the auto space, which has been in our portfolio for some time. The position generated a little bit of a loss in the fund during the quarter. Fortunately, after quarter's end, it appreciated on news about a new major merger. This company, I think most investors know that it has major brands like Alfa Romeo, Jeep, Fiat, Maserati, and many others. In 2016, it spun off its Ferrari business to shareholders, and that business has done very well. And of course, it merged with Chrysler years ago after Chrysler went through bankruptcy during the Great Financial Crisis and eliminated $20 billion in debt. So Fiat has been an astute owner and buyer of distressed assets. We think that its new merger that its board just approved with Peugeot, PSA, will really put the company on good footing going forward. Earlier this year, the merger that Fiat had proposed with Renault collapsed because the French government had certain demands that Fiat simply wasn't able to make. But more recently, as noted here in the slide and described a little bit more in our quarterly letter, PSA and Fiat announced an approved merger where both boards have now approved it and it's proceeding to closing. The deal will be a 50-50% stock combination, and it's creating the fourth largest global original equipment manufacturer of automobiles in the world. It will have slightly under 4 billion euro in annual synergies and generate about 170 billion in sales and 11 billion in operating profit. Very interestingly, and this is actually similar to what the proposal was with Renault, Fiat plans to distribute a shareholder dividend, a special dividend, prior to closing. In this case, it's a 5.5 billion euro special dividend, which represents about 25% of the total equity market capitalization for Fiat stock pre-closing. So that really helps de-risk the investment for us. The business currently trades at about 1.6 times TEV to EBITDA, and management just reported on the quarterly results. The results were great. They've also reconfirmed their guidance. Fiat currently trades at about 14 euros per share, and our rough estimate of its fair value is north of 35 euros per share, which would be over 150% appreciation from here. So we have some good events to look forward to with Fiat as well. You have this big special dividend, then of course the closing of the PSA merger, and as one of the largest global OEMs in the world, we think it'll be one of those types of stocks that nearly every major structured owner, ETF and otherwise, will have to have in their portfolio. So that should give the company stock good support after closing. Let's turn to Frontier Communications, which doesn't have such great prospects. This is a telecommunications company. We are short the stock. It generated a nice gain for our fund. The company provides services through both copper and fiber optic lines, and it was originally spun off from Verizon in 2010. Since then, it executed a very aggressive expansion strategy and really took on way too much debt. One acquisition from Verizon of numerous wireline lines costed almost $11 billion, and it funded that with debt. So today, Frontier has almost $19.5 billion in debt in total. $6.2 billion of that is senior and secured, and then there's an additional approximately $11 billion in unsecured bonds, which currently trade at about 45 cents on the dollar. So you can see that the creditors are very uncomfortable with the company's future prospects. The company generates about $3.4 billion in EBITDA, operating cash flow, but that goes down to only about $800 million a year after interest expense and capex, and it does have near-term maturities, which we think will ultimately drive this company into bankruptcy. And so we're short the stock of Frontier. Our target is 0 for it, which is what happens in almost every bankruptcy case. Shareholders almost always see their stock investment totally extinguished or diluted when a company goes into bankruptcy. It is a near-term event. That would be 100% return from its current levels, although it is already trading at just under $1 a share. Hornbeck is another similar example in a different sector. This is a offshore services company. It provides marine transportation services to the distressed oil and gas industry. It operates mostly in the Gulf of Mexico, where you've seen a very high level of over capacity and a big slowdown due to lower commodity prices. Hornbeck has about $1.3 billion in debt outstanding, which incurs almost $80 million in interest expense per year, but it only generates $17 million in positive EBITDA per year. So this company is sort of is practically walking dead. We think that the lenders to this company will ultimately become its new owners, but it keeps struggling along. Its stock price recently dropped to under 75 cents a share. This morning, I'm just looking at it, it was 47 cents a share. We think it's ultimately going to zero as well. Page 13 has Peabody Energy, another coal company that's also a post-distress equity. It represented 1% of the fund at quarter's end. It did generate a quarterly loss for us of about 1%. We've reduced this position since quarter's end as well. And as with Contura, we offset some of the loss with a corresponding gain from our industry short. This is the world's largest private coal company. It has customers in 25 countries and 6 continents. It produces and supplies about 190 million tons of coal, and it sells that to both thermal customers, utilities that use it globally, mostly in the emerging markets, but also sells a very large amount of metallurgical coal, which is used in making steel. Peabody restructured in 2017 after eliminating almost $7 billion in debt. And as with Contura, the stock dropped during the quarter due to softening demand for both the types of coal that it produces, as well as concern over a global economic slowdown. Now, Peabody also had its own operational issues. A couple quarters ago, it had a fire in its Australian mine, its North Goonyella mine in Australia, and it's still working to get that mine back up in operation, but the date has not been set yet for that. One interesting thing that Peabody's management has done is they have proposed together with Arch Coal to form a joint venture which would combine both companies' steam coal assets into one business, and Peabody would operate that business. It's expected to generate over $800 million in cost savings by combining the two businesses this way. And we think it's really the right thing to do for these businesses, which are, suffering, rapid declines in demand for thermal coal. On the met coal side, though, business is going pretty well, even though met coal prices have dropped recently. Peabody trades at just under 1.4 times EBITDA, which is very cheap for a company with almost $5 billion in revenue and just under $1 billion in EBITDA. It's a real company. It's a big company. It'll be here for the long term. Interestingly, the company's management team has returned over $1.5 billion of cash to shareholders since it reorganized, and that amount compares very favorably with Peabody's entire equity market capitalization of only $1.1 billion. So it's currently trading at about $9.50 a share. There are issues and risks with regard to macroeconomic trends. If we do see a big slowdown or recession globally, probably met coal prices have downside from here, and that should be partially hedged, or actually more hedged now for us with our industry short. But if the economy keeps growing globally, we think Peabody will still be around and keep generating positive cash flow, which it can return to shareholders. In that case, the stock's probably worth over $30 a share, which would be more than a 260% return from current levels. Let's turn to Pacific Gas and Electric, PG&E. This company generated a nice gain for our fund. This is our largest short position. It, of course, filed for bankruptcy in January this year. As I said earlier, it was one of the top 10 bankruptcies of all time. That was PG&E's second bankruptcy. The first time it filed for bankruptcy was back in 2001, when it filed for different reasons. Its bankruptcy this year was really caused by massive forest fires, wildfires in California, starting in 2017 and 2018. Both were the worst, forest fires California had ever faced, with 2018 being even worse than 17's record fires. Unfortunately for PG&E, there are laws in California, and also for its customers, by the way, really, and citizens and people who have suffered from this, which is terrible. But there are laws in California which make utilities strictly liable if their equipment causes fires like this. And as a result, PG&E is facing up to $30 billion in claims from wildfire victims. Now, it can't get out of bankruptcy unless those claims are resolved somehow. And there's a lot going on. There was a new law that the Californian legislature passed recently. It's called AB 1054, which requires PG&E to emerge from bankruptcy by June of this next year. If it does not, PG&E would not benefit from California's new reinsurance scheme, which will help protect it and other Californian utilities from sort of unlimited, uninsurable loss risk like this. So that's a very interesting development. I mean, for a major company like this to be forced to come out of bankruptcy really just a year and a half after going in, when the average bankruptcy takes 2 years to process, here you have one of the largest bankruptcies of all time, and a very strict, short deadline where if PG&E doesn't emerge on time, its whole business model is up to question. So we've been shorting the stock of PG&E for some time. We started shorting it in the 40s. Then we saw it drop all the way down to the single digits when they had their bankruptcy filing. Then it rebounded, somewhat surprisingly, up to the 20s. Now it's back down to the single digits. We've made some money with it. The volatility has been, a little bit gut-wrenching at times. But where we are right now is during the third quarter, the company, as debtor, filed a reorganization plan. And their plan would reinstate the company's equity and cap wildfire claims at just under $19 billion. The plan is backstopped with a $14 billion new money investment from existing shareholders. And the company also partnered with the insurance subrogation claimants to put forth this proposal. Now, our view of this is that, when you think about bankrupt companies, you should really start with the premise that just about every single one that ever goes into bankruptcy in the United States sees shareholders substantially diluted or completely wiped out entirely. So the debtor's plan actually does dilute shareholders substantially, but for some reason, optimism about the shares has caused it, to rally periodically. Shortly after the debtor filed their plan, bondholders partnered with wildfire victims to file a competing plan, and they succeeded in getting the court to terminate the debtor's exclusive right to file a plan of reorganization. So that was a big win. We think the court, was basically becoming frustrated with the debtor's lack of real progress in negotiating a plan that can be confirmed, especially with this looming deadline of June of 2020. It's a short deadline, and I think it became obvious in court to the judge that the debtor's plan relied on numerous unlikely positions that that were just really high risk in summary. So the bondholder plan is much more generous to wildfire victims, and it also dilutes shareholders down to zero, or nearly 0% of their former equity position. We think that, by the way, the bondholder plan, as filed, and it'll probably be revised from here a fair amount still, but it generally has a much higher likelihood of success for a number of reasons. But the main reason is that it reduces litigation risk to the debtor. The debtor's plan includes a litigation strategy about litigating the size of the total tort claims pool or wildfire claimants pool. Now, that could be a make or break lawsuit. The judge overseeing that case might say that claims are much higher than the debtor estimated or much lower than the debtor estimated. If they're lower, wow, that would be a great windfall for the equity proponents. But if they're higher, then this company is truly insolvent, and then getting out of bankruptcy by June would be extremely challenging for it. So the bondholder plan takes that risk away by just settling the size and agreeing to a flat, larger payout to these wildfire victims. The debtor's plan also argues that the state inverse condemnation laws in California are unconstitutional, and it relies on that as one of the important components of its plan. It says that it's going to win this case, but obviously that's another risky litigation strategy that that could go either way, and at best would take 5 years to see to a conclusion. Maybe that goes to the Supreme Court eventually. Who knows? But the bondholder plan does not rely on that either. And there are some other issues that the debtor's plan has that the bondholder plan gets rid of, like for the bondholders, they claim they are due to the contractual rate of interest for post-petition interest after the company filed for bankruptcy, and that they're also entitled to make whole payments on their loans and bonds. The debtor, of course, is denying this. That's creating a big dispute, and it's creating another litigation risk for the plan that the debtor is proposing. If the debtor is right, the company and equity holders could have a big windfall, but if they're wrong, then their plan is, it's dead at the doorstep because it doesn't, it has a big funding gap for this payment that would be owed to otherwise impaired bondholders. One other final point about PG&E's debtor plan that makes it really totally untenable is that California law requires that utilities operating there get CPUC approval, which is the local regulator's approval, the California Public Utility Commission approval, and the rules that the CPUC has require 50% equity capitalization. Now, the debtor's plan is pretty aggressive in that it has more debt than 50%. So we're very confident that PG&E stock will ultimately be extinguished altogether. There's some new developments recently after quarter's end, which make this even more likely. There were new wildfires, the Kincaid fire, and then an additional almost $8 billion in claims, unsecured claims, filed in the bankruptcy case by the state of California itself as a governmental entity and the U.S. government as well. So we're confident that this stock will go to zero. That's a 100% return from its current level of almost $7.50 a share, but it has a lot of volatility, and it'll probably keep having a lot of volatility up until the day it's canceled. Let's turn to Vistra Energy. This is a long post-distress position. It's about a 3% portfolio weight in our fund. It generated a nice gain of almost 50 basis points for the fund during the quarter. Vistra is a Fortune 350 energy company. It was formerly known as TXU Energy. It was a large bankruptcy in 2016. After it emerged, it came out after having eliminated about $34 billion in debt. The company is both a competitive residential electricity provider. It's the largest one in the United States, and it's also a competitive power generator in the U.S. It has total capacity of about 39,000 megawatts and has all sorts of facilities, natural gas facilities, nuclear, coal, solar, and even battery energy facilities that it uses to provide electricity to customers. The company, its business includes a natural hedge because it offers both power generation, as I just said, as well as retail distribution. And so as a result, its earnings profile is much more stable than a company that would have just one or the other side of those two businesses. Last year, Vistra entered into a transformative merger by buying Dynegy, and together, pro forma for the merger after it closed, they were able to maintain valuable tax assets, NOLs, that both companies had, despite Dynegy changing control as part of the merger. In the third quarter, in summary, Vistra generated very strong results. They increased their guidance for 2019. They initiated new increased guidance for 2020. And they announced that they've already executed most of their previously announced $1.75 billion stock repurchase program. They also pay a 50-cent a share annual dividend, and management guided the market that it will start increasing that by 6 to 8% a year going forward. So we like Vistra a lot. It trades at a good discount to fair value. The peer companies trade at about 12 times EBITDA, but Vistra only trades at about 6.5 times EBITDA. If it got even close to its peer industry multiple, it would be trading at about $65 a share, but currently Vistra stock trades only at about $26 a share. So that would be almost 150% appreciation from here. One last company in the coal space, Warrior Met Coal. Let me see, I'll just go through this relatively quickly. This company is a met coal only producer. It produces premium met coal. Its predecessor, some people on the call might remember this company. It was called Walter Energy. It filed for bankruptcy in 2015, and as a result was able to reduce its debt from about $4 billion to only $85 million net today after its bankruptcy and eventual IPO. During the third quarter, Warrior generated significant free cash flow, and they had their highest quarterly sales volumes in the company history. They affirmed their guidance for this year. Now, interestingly, they reiterated their preference for future special dividends to shareholders. So they're not buying back stock and reducing the float like some of the other companies are. In this case, they're just returning cash to shareholders. They've done that a lot, and they have had a couple of very interesting large stock buybacks. Warrior trades at just 1.67 times EBITDA, which is well below our estimate of fair value. And if you consider their most recent special dividend, they have a trailing dividend yield of 22%, which is pretty compelling. It's currently trading at about $17.75 a share. Now, Warrior, if we don't go into a massive global recession and business continues somewhat as it's been continuing so far, we think the company's stock could be over $45 a share, in the relatively near term. So that would be 154% appreciation from where it's currently trading. As we said a couple times now in the call, we do have industry exposure hedged here, and we've increased the percentage hedge as a percentage of the book and as a percentage of the remaining long positions we do have in the coal market. Just a couple final words about special situation investments before I turn it back to Bill. We did do well realizing most of our remaining special situations investments. If you look at the chart here on page 17, we have invested slightly over $470 million and generated from that slightly over $710 million in realizations, plus $4.9 million still unrealized. That's a 26.4% gross IRR. As a result of this, we solicited investor interest late last year, and were able to complete a $130 million IPO of a new special purpose acquisition vehicle, a SPAC, which our fund sponsored. So if you turn to the next page, page 18, I'll just give you a couple quick words about the two primary remaining special situation investments, and then say a couple of words about the SPAC before I turn it back to Bill. But Washington Group International, this position is a pro rata beneficial interest in a creditor trust called the WGI Creditor Trust, which was issued to former creditors in the Washington Group bankruptcy. Since that company filed for bankruptcy and came out years ago now, the trust has distributed hundreds of millions of dollars to its owners, including our fund, and we've done very well with that. During the quarter, the court reopened the case to approve one final distribution. So we're excited about that. It's actually going to enhance our IRRs, which are already quite nice, of about positive 48% for the stock and about 25% for the bonds and trade claims. I think most people on the call are familiar with our successful investment in Werner, which was the world's largest ladder manufacturer that we used to own and sold about almost 2 years ago now. We did very well with that investment. We helped it increase its EBITDA from a negative position to over $100 million at the time we sold it, which helped us generate nearly $900 million in selling that business. What we have left with Werner is just there's an escrowed amount of cash. It's about $21 million in cash sitting in escrow, and it's subject to an ongoing dispute between the buyer and seller, which had been in New York Supreme Court. There's currently an appeal that we filed, but we think this will actually wind down pretty soon. There are only a few remaining legal issues that are open, including who's going to pay the litigation expenses for each party and how will the prejudgment interest be paid, if any. So there should be an update on that in the near term. About our SPAC, Schulte Special Purpose Acquisition Corp. It's listed on NASDAQ. The ticker is SAMA. This is a blank check investment vehicle that our fund sponsored, as I said earlier. And it's really designed to bring public a firm that we identify whose growth can be accelerated through our expertise and operating experience. We're excited about the SPAC and we're excited about the opportunities that it's been looking at. We don't have a deal to announce yet, but we're optimistic that we'll have some information about that in the near future. If anybody has questions about our SPAC, please call our office, and there's also there are public filings available about it, SEC filings, 10Ks, 10Qs, and of course its original prospectus. So if you need a copy and can't find one of those, let us know and we'll send it to you. So with that, let me turn it back to Bill. Ladies and gentlemen, thank you for listening to the call, and I'll let Bill wrap it up and then open it up for Q&A.
Thank you very much, George. In conclusion, as we highlighted, we continue to believe we have numerous compelling investment opportunities, and true to our strategy, they're both long and short across the capital structure, both in a hybrid fashion, both liquid and illiquid. We're really beginning to take advantage of all those opportunities that present themselves, as we highlighted in the deck, whether it's the Lux, etc. But there are numerous opportunities at this juncture, and we're excited about them going forward. Albeit we were down for the quarter, I think we discussed some of the reasons for that. We think that we're well positioned to look into year end and into 20. And that said, we did outperform our primary benchmark in that sense. We highlighted some of the difficult names, like we said, in the commodity metals and mining sector. We continue to hedge that out and have obviously curtailed the exposure there with a lot of the uncertainty, but continue to look for good macroeconomic trends, moving ahead and looking ahead, and we see potential upside for certain value-oriented names with event-driven catalysts, which is really the key to our overall portfolio. We continue to highlight that we would temper some of our long exposure, one's long exposure, and continue to hedge out some of that exposed risk as well. And like I said, default rates do remain low, but like I said, we continue to find a lot of opportunities. Those opportunities are growing, and I think as we enter later this year and into 20, they're going to continue to grow. I think many of you have seen in the press some of the beginning dislocation in the leveraged loan area. We highlighted the sudden drops in CLO holdings like the Lux and others. Those are beginning to reverberate through the overall leveraged loan market and high yield market, and we think we're going to have more opportunities ahead of us. Our portfolio is very attractively priced, like I said earlier, and to reiterate, trading below 5 times, below, well below the 14.6 times of the Russell and well below the S&P, and really is somewhat of a defensive posture in that sense. Our overall funds, both on the long and short side, have many interesting catalysts going ahead that really should help drive our portfolio and the market prices of our securities closer to fair value. George highlighted a lot of those target prices of our existing names, and we look forward to finding additional ideas as the year comes to a close and we look into 20 for new opportunities. So once again, thank you for joining us. We appreciate your loyalty of everyone involved as we come to our 22nd year of being in business, which is very exciting in and of itself. So I'd like to, again, conclude. You'll see on the screen right now a picture of how to raise your hand to ask any questions, and the lines are open now, so please click off on the screen to raise your hand, and we welcome any and all questions. Anybody out there? Raise your hand, please. Go ahead. Evan? I think you may be on mute, so unmute yourself and please ask your question. Kevin? I think you're on mute. Anyone out there?
Can you hear me?
Yes, sir. Go ahead. Go ahead. We hear you. We hear you.
Can you hear me now? Can you hear me now?
Yes, we do. Yes, sir.
Oh, yeah. My question is, with the way, I know you're de-risking in sort of the commodity mining space. What is the view of sort of all this ESG governance rules that it's entering the large institutional portfolios? I mean, is that proving to be a hindrance in raising capital for the fund? You understand my question?
Yes. George, you want to take that? I could add to it as well.
Why don't you talk about it in terms of raising capital for the fund, and I'll talk about it in general.
Okay, great. In terms of it, first of all, we'll just step back for 1 second as it relates to our carbon exposure, coal exposure, mining, what have you, or anti-ESG, if you will. Our exposure is majority, or has been, despite it being now a smaller portion, has been on the metallurgical side. So it has not been particularly, if you will, directly in the crosshairs of the overall climate issue or ESG space. That said, there's no question that coal in general does fall into that overall bucket. As it relates to overall fundraising, obviously anyone who is ESG focused and has those governance rules in place in their portfolio and allocation process, it's not a place that they would consider investing in a fund when they would do their due diligence and learn and see of all of our exposure. We do not directly market to ESG. We feel that we're generalists, and obviously within the distress world, a lot of distress occurs in overall energy and fossil-related fuels and things that would be considered verboten for ESG investors. So in that sense, we do not target directly to ESG, obviously. It's not the easiest place to go. So the short answer is ESG money, we would not be their first place, but it's not something that we really focus on in that sense, because we think the opportunity to make money and find opportunities will be, override that at the moment.
I would like to add a couple, quick comments as well. Our offering doesn't restrict us from investing in any type of industry or theme.
Okay.
With regard to ESG specifically, I mean, it also doesn't restrict us from buying loans that pay interest or investing in tobacco companies or anything like that. So if there's an investor that's on this call or that's interested, in working with us because they like our ideas, but they're looking to exclude, certain themes or assets because of, their own investment restrictions, we can work with them, and I would suggest in that case maybe through a managed account that, allows everything else but restricts those specific types of investments. So we have that flexibility, to set up managed accounts for those types of things.
Okay.
And as Bill said, regarding coal, if you think about the investments we've made in that space, they're really focused predominantly on metallurgical coal, which is used to make steel, and it's a requirement. It's a key part of the steel making process that can't be avoided. So if there's an investor who can't invest in coal that's made for steel, that investor, can't invest in the economy. The short answer again is no, we're not restricted that way. But two, our view is that met coal is here to stay, even though its prices are volatile, and it's required for the economy to function. Part of the reason the met coal sector sold off is because of lack of confidence in the quarter and year, due to politics about a potential infrastructure bill in the United States. I mean, and I think every investor on this call and probably every investor around the world realizes that the United States has an infrastructure problem and has to spend money, and use steel to refurbish the nation's infrastructure. So, if you're opposed to that for political reasons, it's something that we're not going to change our offering for.
Right. Okay. That's a good. That gives some clarity. I find that some of these institutional investors now are putting in these new charters where they're screening these investments for ESG compliance, and I'm not quite sure how. You gave me some help there. I'm not quite sure how to address that. That's all. That's I mean, I think that's why all the fossil oil stocks, mining stocks have been really punished this year for, I think, over punished, not necessarily because of economic performance, because of these big institutional players, whether it be Man Investments in London, the largest publicly traded hedge fund that now has these criteria in place, or these large pension funds that are, gradually, putting these things in place, that it's putting pressure on the whole sector.
Okay. Yeah, good question, Kevin. I mean, we certainly have to, be cognizant of that, and good business often coincides with, with good business. Truly good for the environment business. But in this case, we think that the coal story still makes sense for the met coal portion of it in any case.
Okay.
I think but with regard to oil and gas, by the way, though, I think the sector has sold off more just because there's a huge amount of additional supply with fracking. I mean, it's just totally turned the normal.
Okay.
It's turned the picture upside down. I mean, the U.S. is now the largest exporter of oil, and there's so much more abundant new supply that the old ways of thinking about this space no longer make sense, and that's disruptive, and it's a totally new development that just sort of caused, I think, the sector to trade off too.
Is that an area you think, when you look forward over the next 12 to 18 months, in terms of what sectors are developing, profiles of distress? Would you say the oil patch, and you think it's going to come under another renewed period of pressure, bankruptcies, reorganization, like a bust, another oil bust, than like the Texas area?
Good question, Kevin. Oil has been volatile since forever, going back to Rockefeller. And it goes through booms and busts, and it's a very volatile commodity based on the current outlook on that given day. I think for those companies that have excessive leverage operating in the space, whether they're drillers or upstream, companies or servicers. They might be transported. They might offer, offshore drilling rigs, and there are a lot of them, that are simply over levered. I think the way to think about it is really consider the amount of leverage that each company has, and we're at a point where, I would say it's realistic to call the amount of debt issuance we've had in the past, several years a debt bubble. So when junk-rated debt, is issued just so profusely for these types of companies, which have a pretty volatile earnings stream, I think unquestionably there'll be more distress. I don't know if it's going to cause, the price of oil to drop to $10 a barrel as a result. I can't predict that. If I could, I'd be, I wouldn't do what I'm doing. But I do think that there'll be individual companies that are at risk, and there'll be interesting values, as well. There are some companies with a very low cost of production that have already restructured their balance sheet. One that comes to mind that we didn't talk about on today's call yet is Samson. Samson Resources used to be a huge natural gas company. It was the largest natural gas LBO at the time. Then it filed for bankruptcy. I think it wiped out about $4 billion in debt. And today, I just looked at its financials earlier today, it's totally transformed its business. Now it's an oil producer in the Powder River Basin with a relatively low cost of production per barrel and no debt at all. It's been paying special dividends to shareholders and selling off non-core assets. And so, that's an interesting long investment, and we own it in our fund already. I think you can make money regardless of where the oil price is today, if you buy right and pay particular attention to the balance sheet. Okay,
great answer, George. No, thanks for giving me, because it gives me a little more clarity as I'm talking to some people, and let's see if I can get some traction. I do think that there is finally, some people are sort of taking some money off the table and looking for diversification now, which hasn't really been the case for the last several years. So we'll see. So, well, good call. I'll see you later. Thank you for your time.
Okay. Thank you very much for the question. Anyone else out there? Anyone else? I don't see any more questions. So we thank you very much for your time this morning and your participation. Thank you for that good question. We look forward to being in touch and for getting into year-end on better footing as we've repositioned ourselves and into 20. So again, thank you very much and look forward to being in touch as we move ahead. If we don't speak to you between now and Thanksgiving, have a great holiday start of the season. And thank you very much. Have a good day.